Hey everyone, happy Thursday, April 3rd. It's about 10 a.m. on the West Coast, and it's time for another market update. This week was supposed to be about that. We got a big inflation report last Friday, all the jobs reports coming out this week. However, that's all been overshadowed now in the markets by President Trump's tariff announcements that came out yesterday, Wednesday. Um, Going into it, the markets weren't excited about this, but they started to think that maybe, hey, these tariffs won't be as excessive as we're worried about. However, they came out a little bit more than they were expected, and that's caused anybody looking at their 401k today know that stocks are down quite a bit, crypto's down quite a bit. However, mortgage rates are down quite a bit too, and so let's get into why. Um, Looking at this chart, this is the initial reaction to the announcement yesterday. Markets were closed, but they're still trading going on after hours. This orange line is stocks. And as you can see, as the announcement happened, stocks tanked. They went down quite a bit, continue to come down today. However, they're off their lowest of the days, but still down quite a bit. But at the same time, this blue line is the 10-year U.S. Treasury yield, and that tends to be pretty closely tied to mortgage rates. When it goes up, mortgage rates tend to go up. When it comes down, like it did after the announcement, mortgage rates tend to come down with it. And a lot of that has to do, this reaction to these tariffs has a lot to do with, what they think these tariffs are going to do to the economy. The tariffs can be inflationary, which wouldn't be good for mortgage rates. However, right now, economists and the markets basically are looking at these tariffs as more causing an economic slowdown, or worst case, a recession. And as we've talked about before, recessions aren't the worst for mortgage rates, and they're not the worst for home prices either. Looking at this chart, this is home prices during recessions, shaded as a recession, and line is home prices. And as you can see, besides the housing crash recession of 2006, era, home prices have gone up through every other recession going back to 1975. And again, we could talk about why 2006 is a lot different than now. 2006, there was about 4 million homes nationwide. My industry was giving loans to folks that weren't very well qualified and ended up getting foreclosed on and couldn't afford the home when things went bad for them. Whereas now, there's only about 1.3 million homes nationwide. So not a lot of inventory out there for us to pick from. So not the influx that there was, or not this oversupply that there was back then. And then our industry is a lot more strict now, a lot more well qualified people, a lot more people with equity where they didn't have a lot of equity back then. So lots of reason why homeowners and the industry is in a lot different place than it was back then. But as you can see, home values tend to do good in economic slowdown slash recessions. And the other part about this, mortgage rates, same thing. Mortgage rates tend to come down, during recessions, and a lot of that has to do with the economy slowing down and so forth. So, overall, didn't like seeing my 401k down, didn't like seeing crypto down, but I did like seeing mortgage rates down. Mortgage rates, after the last couple of years with rates being higher, a little bit of an economic slowdown wouldn't be the worst thing. As long as not too many people lose their jobs, as long as home prices stayed about the same ish, it wouldn't be the worst thing for our industries if we see rates come down. Next thing, February PCE. So, like I said, last Friday, we did get the Fed's favorite form of inflation to take a look at. And that came in, about expected. Headline up 0.3 month over month, at 2.5, as was estimated year over year. But the core number, which takes out food and energy prices, that came in a little bit higher than expectations. Supposed to be 0.3, was at 0.4 month over month. And then that ticked the year over year number up to 2.8. However, if you look at the shorter averages, the 3 month run rate and the 6 month run rate, it's even higher than that 2.8. It's at 3% for 6 months, and even shorter, 3.5% over the last 3 months. So we know the Fed was targeting 2% for that number. So, we're going the wrong direction. So it'll be interesting to see how these tariffs and everything, affect these numbers as we go forward. And then the reason for that, utilities were a little bit hotter this month, or in February. Healthcare was hotter, and computer software. And the other part about this, personal spending dropped a little bit, which again shows, the more we're spending, the better we feel about the economy. The less we spend, that obviously causes a little bit of an economic slowdown, since, as consumers, we drive our economy. Personal income was up month over month, but January was revised down. And again, anything income related, tends to be inflationary. The more we make, the more we spend. So these kind of offset each other. But then private sector wages was down. It was expected to be at about 3.9% year over year, or was last month, and dropped to 3.2%. So the more money we have, the less we spend. If we see income start dropping and we see spending start dropping, that tends to lead to economic slowdowns. And then, as I said, this week is jobs week. So we got February JOLTS and March ADP. The JOLTS reports job openings that came in about expected, 7.6 million, I believe, a little bit under that job openings. And then we got the March ADP yesterday, and that came in hotter than expected. So again, showing the opposite of an economic slowdown. The better the labor market's doing, the hotter our economy tends to run. And that came in about, those dark blue lines are the ADP numbers, and it came in at 155,000 jobs created, where the expectation was about 120,000. And then the light blue number is the BLS jobs report, which we will get tomorrow. The big one is where unemployment numbers come from and whatnot. That is expected to be about 135,000. So if we see that number and unemployment rate to stay at 4.1%, so if we see those numbers come in, higher or lower than expected, that could be market moving, but the markets might still be obsessed with these tariffs numbers, and might not have as big effect as it would in a normal week, because definitely this tariff rollout has definitely spooked the markets. Initial jobless claims. So new unemployment claims, people getting laid off, applying for unemployment, was at 219,000 new claims. Estimate was 225, so still really low there. So it'll be interesting to see if that number starts climbing as we see more layoffs and things along those lines. So where does that leave us? The average 30-year conventional rate was at 6.63 this morning. Last week it was at 6.8. So moving in the right direction. Like I said, with these tariffs announcements, we dropped. Most of that drop was all today. The rest of the week was pretty flat. So if that BLS jobs report comes out tomorrow, with less jobs created and unemployment ticking up, that we could see that number drop even more. I think the lowest we've been over the last 12 months is 6.11, and then we got a bad BLS jobs report for us. So if that could happen too. If tomorrow shows a really really strong BLS jobs report, maybe we see this number tick back up. But it's like to see us break that 6.5 number and then make our way down to 6, because if we can get a 5 in front of it, that'd be awesome. Important dates coming up. So we got the BLS jobs report, like I said, tomorrow. Got to keep an eye on that. We got inflation, CPI on April 10th. We got that PCE report again on April 30th. And then the Fed's next meeting, well, they'll make an announcement on their rate, is May 7th. Right now, the markets are looking at about a 25% chance they cut rates, which is up from last week. Again, these tariffs have basically made the markets think, well, maybe they will cut, depending on what happens over the next month. And then about a 75% chance they do nothing, they stay where they're at. So, again, don't want to see people lose their jobs. Don't want to see too much of an economic slowdown. But anything that will make mortgage rates come down a little bit is, in my opinion, is a good thing. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.